Hi everybody, good evening, and thank you all for coming out on this cold, wet, but dry Scottish day. I thought I would just introduce myself, and you probably met some of my team earlier on. You'll probably be joining us at some point. My name is Gurjit Singh Lalde, and I'm the Executive Director of Asia Scotland Institute. We're a young organisation. We've been around for 2 years, and we've had over 30 events, mainly in Edinburgh, but we hope to have more in Glasgow. And the purpose or the mission of the Institute is to promote a better understanding of what's going on in Asia to those that are in Scotland, whether it's around education or culture or the arts or business or politics and policy. And our definition of Asia is from the Middle East all the way across to Japan and from Mongolia all the way down to Indonesia. So a wide geography and a wide range of topics. I want to say thank you to the Confucius Institute, who we hope to do more events with in the near future. And we were just talking while we were waiting outside for the fire drill to stop about a major event that you have for the Chinese New Year, which sounds very exciting. And we'd love to attend and maybe even participate in it. So tonight's talk, corporate governance, something that's very close to many of our hearts, something that affects us all, and something that I'm sure we're all passionate about and maybe will become involved with in our future careers. And we have the global leader here in that study, Professor Colin Mayer. I'll read a little bit of his bio, but I'm sure you've already seen some of it online and maybe even heard some of his talks. Professor Colin Mayer, he's at the Management Studies of SOES Business School at the University of Oxford, a very well-known institution like this one. He's a professorial fellow at the Wadham College, Oxford, an honorary fellow at the Oriel College at Oxford, and St Anne's College at Oxford as well. He's a fellow at the British Academy and the European Corporate Governance Institute and the Royal Society of Arts. Colin was the first professor at SOES Business School in 1994, although he looks much younger. He was the Dean of the Business School from 2006 to 2011, and he was the first director of the Oxford Financial Research Centre from 1998 to 2005. And he's held various fellowships and visiting professorships at several of the world's leading centres of economic research. Colin was also the chairman of Oxera Limited between 1986 and 2010, which is one of the largest independent economic consultancies in Europe. He's consulted for numerous large corporations and for governments and regulators and international agencies, and recently published a book called Firm Commitment, which I strongly recommend you buy. You can find it on Amazon. It's a very good read. I don't think he has any copies here, but if anyone has a copy, I'm sure he'll sign them at the end. In the book, Colin sets out an agenda to reform and re-establish the corporation as an institution that we can value and trust. This is a hugely important issue in Asia, as it is around the world, both for the well-established global companies of countries like Japan and for the emerging corporate giants of China and other emerging economies. So we're pleased to have Colin here with us today to talk about these major global issues. And with that, I'd like to hand you over. Thank you very much.
Thank you very much indeed for those kind words and that very kind introduction. Woody Allen, the film producer, once said, "Since light travels faster than sound, people appear bright until you hear them speak." Thank you in particular for the promotion of my book, and I didn't even pay him to do all that, so that's really generous. So I'm going to be talking on the subject of corporate governance, and I'll say a little bit about what that means in just a bit. But really the focus of what I want to talk about is the relevance of it to what's going on in Asia. And what is going on in Asia is really very substantial, very dramatic, very important for the whole of the world. And the history of this is that it's been a turbulent progression because it was 17 years ago in '97 that we had the Asian crisis, when a number of Asian economies collapsed at the same time. And the response of the international bodies at that time was basically to condemn the nature of the governance systems of Asian economies and Asian firms, and in particular what was regarded and what Alan Greenspan, who was then chairman of the US Federal Reserve Board, said was crony capitalism. Crony capitalism in the sense that firms were owned by families that exploited those firms. They were owned by the state that was inefficient. There was a lot of cross-shareholdings between companies and between banks and companies. And he said, and the IMF said, they should all be broken up. And what was required was to make Asia look like North America and the UK, with dispersed ownership, held by a large number of individuals and financial institutions, not these dominant shareholdings by families and the state and other companies. But some 4 years later, that great authority on the subject of corporate governance, the US itself didn't look very good when you may recall that there was a great bubble in internet startups and high-tech companies at the beginning of the 2000s, and that suddenly burst, and the stock market crashed in 2001. And what it revealed was a lot of crony capitalism in the United States, with misreporting of profits and accounting statements by Enron, the energy company, by WorldCom, the telecoms company, where they just basically misstated their profits and their assets. And as a consequence of that, the US then tried to tighten up its corporate governance and change the rules regarding accounting statements, in particular, how companies state their profits. And everything looked to have been put back into order and was normal again until, of course, some 4 years later, 5 years later, we had the financial crisis. And the financial system of the United States and the UK in particular ground to a halt in 2007-8. And all of that reform to the corporate governance standards in the United States was not sufficient to prevent real failures in terms of the governance of financial institutions. And indeed, what was rather striking about the failure of those financial institutions in that crisis in 2008 was it was apparently the institutions that had the best corporate governance standards. I'll come on and I'll talk in a little bit by what people regard as being the best standards in just a minute. It was those that failed the most. And it was the ones that rewarded executives most closely in relation to their share price performance and their financial performance, that the ones that took the greatest risk. So all of those notions as to what was needed in terms of good corporate governance turned out to be exactly wrong. Those were the financial institutions that failed the most. So today, we now look back over a decade or so of accounting scandals, market manipulations, LIBOR scandals, where the LIBOR market was being fixed by the banks. The foreign exchange markets have been fixed by the banks. There have been mis-selling of mortgages in the United States, mis-selling of a form of insurance known as payment protection insurance in this country, alongside the financial crisis. And outside of the financial sector, we've got tax avoidance. You're reading every day now about how companies like Starbucks and Amazon and Apple are paying essentially no tax or virtually no tax despite their huge profits. And executives are paying themselves increasingly outrageous salaries. And that leaves aside the environmental disasters that have occurred in the Gulf of Mexico and Fukushima and places like that. So there's a real heart-searching reevaluation of the way in which we're running companies in the Western world, in a sense that we've got it wrong. They're not doing what they should be doing. What we want to have are companies that are sustainable over the long term, that are profitable, yes, but that they have other objectives. They're not just there to make money. They should be prosperous in terms of long-term growth and looking after other members of society and their communities, like their employees and the communities that depend on them, and all of the companies that trade with them, that they should be essentially looking after the interests of parties well beyond just their shareholders. So that's the agenda. That's the agenda in Western Europe at the moment. And bear that in mind as I now take you to Asia. Okay, now, I'll start off by just telling you a little bit about the changes that are currently in progress in China. And the starting point is that there are some very striking features about the nature of ownership of Asian corporations. And that is that, for the most part, they are, as I was saying in relation to the Asian crisis, held by families. This shows the percentage of listed companies in China, Hong Kong, Japan, and South Korea. And it shows the distribution of the main shareholders in those companies. It doesn't list all of the shareholders, but it's showing the main ones there. And you can see, at least in the case of Hong Kong and Korea, this refers basically to 2000, the beginning of this century, that at that stage, the dominant shareholders in those two countries were families. In the case of China, on the other hand, families were relatively infrequently observed, but the state was the dominant shareholder. Japan, which I'll be coming on to talk about a bit later on, is an interesting case because it looks superficially as if it doesn't have much in the way of concentrated shareholdings and actually not much in the way of family shareholdings, and it looks to be quite widely held in the sense in which we might think about it in UK and US firms. But actually it's very different because it takes the form of cross-shareholdings between companies and banks, of interlocking holdings. So it's not quite as outwardly looking as that slide might suggest. But in any event, let's just focus on China for the moment with that dominance of the state, because that's changing dramatically. So this shows you what's happening in terms of the percentage of employment in China that's attributable to state-owned enterprises, SOEs. Now, there's quite a difficulty in terms of doing these analyses for China, because at least towards the end of the 1990s, there was this fundamental change in the way in which state-owned enterprises were classified. Up until 1998, a state-owned enterprise was an enterprise that was 100% owned by the state. But thereafter, they recategorized it to include dominant shareholdings as well. So there tends to be a bit of a disjoint at the end of the 1990s, and that's why we've used a different color to. But anyway, you can see what's been happening. It was approximately a constant share of employment in China in state-owned enterprises up until about the end of the 1990s, and then this dramatic decline that's occurred during the 2000s. And if you look at it in terms of output, then you can see that, again, similar pattern of a declining percentage of output that's attributable to state-owned enterprises. And you can see here how the government has been selling its shares in the listed state-owned enterprises. So from around about 60% of shares held by the government in state-owned enterprises in 2003, that's dropped to 20% by 2012. So a real withdrawal of the state from its ownership of its own state-owned enterprises. Now, despite the fact that the percentage share of output attributable to state-owned enterprises has declined, this shows the average output per state-owned enterprise. And what this is showing is that they've become more productive. Yes, and it shows in particular from the end of the 1990s that output per state-owned enterprise has gone up substantially. So the state's been withdrawing as in terms of its total output, but each of the state-owned enterprises is becoming more productive in terms of the output it's producing. And you can see that relative to the national average, state-owned enterprises, at least from the end of the 1990s, have been climbing up. They were declining in terms of their relative productivity relative to the national average, but they've been doing at least a bit better since the 2000s. And that's also shown in their profitability, where they were becoming increasingly unprofitable until the 1990s, but that's been reversed since the 2000s. But notwithstanding that improvement in profitability, as this slide from The Economist shows, the profitability of state-owned enterprises, while it's been rising, has not kept pace with that of other enterprises in China, the non-state-owned enterprises, the private enterprises. So the state-owned enterprises have become relatively inefficient and unprofitable. And so that's really the background to the debate that's currently going on in China about reforming its state-owned enterprises. And basically the view that prevails in China is that these state-owned enterprises are bureaucratic, they're too large still, they're inefficient, they're propped up by state subsidies that are very distorting in terms of how they make their resource allocation decisions, so that they put too much into the highly subsidized areas and not enough into the areas that are not subsidized. They're still, for the most part, monopolies, distorting the market in terms of exploiting them as monopolies. And above all, they are subject to political influence and the distortions that come from the guidance of the state. But at the same time, there's a considerable reluctance to go along the Western model, to shift in a direction of adopting UK and US styles of capitalism, because, in particular, the UK and the US, and when people in China talk about the Western model, what they basically mean is, first and foremost, the US, and then they might talk about the UK, but beyond that, they don't really talk a great deal about other European countries. So basically, the concern that arises in relation to the Anglo-American model, which is perceived to be highly unequal, highly distributionally unequal, a system that where there's prevailing greed that dominates the running of the Anglo-American capitalist system, which is very socially divisive and is highly short-term. It's basically looking to generate short-term profits at the expense of long-term prosperity. And not only is it very short-term, it's short-term in terms of a financial objective rather than trying to pursue the wider interests of society more generally. So basically, the notion of adopting an Anglo-American type of system is rejected. But nevertheless, there's an ambitious agenda going forward, as set out in the third plenum of last year, in which the government, the state, said that they're not going to abandon public ownership. Okay? So the principal control of the state is going to persist, but that's going to be in the context of what is described as being a mixed ownership system, by which they mean that there should be more private participation, more private investors in those state-owned enterprises, and more interrelationship between publicly owned entities and privately owned entities. And the World Bank, in its China 2030 report, set out an even more ambitious agenda that large firms, including the declining number of SOEs, should become more modern in terms of their corporate governance with professional boards, etc. So that's the path on which China is moving. And really the issue is whether it can achieve the objectives in terms of introducing some of the benefits associated with Western systems in terms of their greater efficiency, their focus on efficiency of corporations to generate profit, and also their more innovative, flexible response to changes and technological changes in particular, whether or not those benefits of Western systems can be combined with the benefits associated with the Chinese model as it's been observed in the past. And it's incredibly important to bear in mind that this model, which was derided by the US and the IMF at the end of the 1990s, has been the source of immense growth, incredible transformation of the Chinese economy over the last 20 years. So there's no question that it has been a significant contributory factor to a long-term profile, to long-term investment in helping to stimulate growth and prosperity in China. But that the sense is, as these statements here exemplify, that that's beginning to have run its course, and that there needs to be a gradual process of adaptation going forward, which changes the nature of the model to what is described as being a mixed ownership system. So the underlying question is it possible for China to get the best of both worlds in terms of the reform going forward? And for the most part, I'm going to answer yes. I think it is. And to see that, one needs to first of all start off by understanding, well, what is corporate governance? And there's a traditional view of corporate governance which is actually excruciatingly boring. Okay? It's all about the boards of companies and how the boards of companies are constituted, with a degree of independence of the directors and the chairmen of boards, the way in which new board members are brought on and replaced, the role of audit and risk management, how board members are paid, relationships between companies, their boards and their investors, and the extent to which shareholders are active and engaged in overseeing their companies. Now, that's not the most exciting of agendas to have to address, and it's also associated with a whole series of policies about legal systems and contractual rights of different parties and the degree of protection that shareholders have, the extent to which shareholders have a say on the executive remuneration of the directors of their companies, whether or not they're active in putting forward resolutions at shareholder meetings, and things like potential conflicts that might exist between different parties, related parties to companies. So it's all corporate governance, as it's generally described, is a fairly technical topic associated with the nature of boards and the running of companies and the legal systems and regulation. But I'm going to really suggest it's much more exciting than that, actually. It's got much more substance than that, just that rather arcane set of issues. And in particular, that really what is needed is to address exactly these sorts of issues that I was just talking about, in terms of, can China achieve the goals in terms of real economic performance going forward, in terms of continuing the sort of development and growth that it's been observing today, in terms of becoming more innovative, entrepreneurial going forward, but at the same time not to lose the success in terms of social cohesion and avoiding some of the pitfalls in terms of disparity of income that have pervaded, in some respect, in particular, many other Asian economies, such as in India, where one observes a far greater disparity of income than has been associated with the Chinese growth. So really, that's the sort of agenda that corporate governance should be concerned with, not simply the nature of boards. Now, I'm going to quickly, and I'll have to take you through this quite quickly. I'm just going to take you through the way in which governance operates in a number of countries around the world. And I'm going to start off with the UK because, and I'm not just saying this because we're in the UK, but the UK is generally regarded as being a model of good corporate governance. In part, it's regarded as being a model because it started to address these issues before other countries. It set up back in the early 1990s something called the Cadbury Committee under the chairmanship of Adrian Cadbury to look at the appropriate response to a number of failures that had occurred, in particular in relation to Robert Maxwell's empire of companies in the UK, and what needed to change in terms of governance. And basically what he came up with was a set of recommendations about the way in which the boards of companies should run and be constituted, and in particular he set out a set of rules which he said should be on the basis of comply or explain. Okay? By which he meant if either comply with these recommendations or explain why you think it's inappropriate to adopt them, why you should do something different, a very sort of British approach to things. Here are the rules, but if you can come up with a good reason why you shouldn't adopt the rules, then just tell us. Now, that notion of governance has then been included in a set of principles that take the form of a governance code, a corporate governance code, and something known as a stewardship code, which not only tells companies and boards how they should run themselves, but how institutions should behave in relation to the companies in which they invest. Because there's a feeling that the institutions, like the pension funds and the life insurance companies that invest in companies, are not taking their role as owners sufficiently seriously. Inadequate stewardship, as it's termed. So I was just saying that alongside those core components of corporate governance are also rules that come from the stock exchange when companies want to list their shares on stock exchanges, which in particular, and I'll come back to this a bit later on, say that companies cannot come to the stock market if they have what are termed dual-class shares. That is to say, shares that have got different voting rights for different types of shareholders. That is regarded as being really contrary to British notions of fairness. You know, it's a bit like playing cricket. Everyone has to play according to the same rules. And one of the rules is that you cannot have different classes of shares, just not playing cricket properly. Now, as we'll see, that is very different from the way in which many stock exchanges around the world operate. And another set of rules that's important is in terms of the way in which takeovers are organized. And in particular, a rule that says that unlike in the United States, companies cannot defend themselves through having poison pills, takeover defenses that prevent them from being taken over by other companies. Now, there are, in terms of the corporate governance rules, there are a whole series of quite detailed rules relating to the leadership of companies, their boards, the accountability, the way in which management is paid, their relations with their shareholders in terms of the Stewardship Code, in terms of the way institutions have to behave in relation to their companies, avoid conflicts of interest, monitor the companies they're engaged in, intervene when they're failing, take out collective action with other institutions when they're turning around failing companies, voting at shareholder meetings, and reporting how they're actually discharging their obligations in terms of these stewardship functions. Now, those really detailed rules around corporate governance have at the same time been associated with a dramatic feature of the UK stock market. And that is, it's basically disappearing. You know, over the last 20 years, the number of companies listed on the UK stock market has halved from 2,000 to less than 1,000. And the US is not that different. Since 1997, around about 38% of listed companies have delisted for a variety of reasons. So here we have, on the one hand, what look to be model rules of good corporate governance designed to provide exactly the right oversight of companies at the same time as we're observing that the stock market is becoming less and less significant for at least large companies. And not only is it that companies are withdrawing, so too are some of the most important investors. It used to be the case that British institutions were basically held by long-term institutional investors, pension funds and life insurance companies. But as I'll show in the next slide, they've basically withdrawn. And their place has been taken by a combination of hedge funds, private equity firms that are, in particular in relation to hedge funds, short-term investors, and in the case of private equity, largely financed by debt. Okay? And this gives you an illustration of that dramatic change. If you look at the lines showing as insurance companies, the second line, and pension funds, the third line, you can see in 1999 they added up to about 50% of UK equity. They held about half of the shares of listed companies. By 2010, that had gone down to 14%, 14%. And it's other institutions, by which I mean private equity and hedge funds, that have increased alongside a substantial increase in foreign holdings. And basically what's going on is that we're getting companies withdrawing from the stock market because they don't like the prescriptive rules under which they're expected to operate when they're on the stock market, and they don't like this changing nature of the ownership of their companies, which is becoming increasingly short-term in nature. And this makes the point pretty clearly that 70 years ago in 1966, the average holding period of shares in the stock market was 8 years. 30 years ago, in the middle of the 1980s, it was around about 4 years, 3 years, no, about 3 years. And recently, it's been less than a year, a matter of months on average. And in the case of many of the investors, they hold shares for a matter of hours, minutes, seconds, nanoseconds. If you include high-frequency trading, the average holding of shares on the stock market is less than a second. Now, you know, what sort of investment policy do you think companies are going to be following when their investors are becoming so short-term in terms of their own holding periods? Right, so, you know, here is, in one respect, a model of good corporate governance, and on the other hand, a system that is apparently under serious malfunctioning. And that leaves aside all of the issues that I was talking about earlier on about the social problems associated with capitalism. Now, that picture is very different from the rest of Europe. Elsewhere in Europe, the proportion of shares, companies that are listed on stock markets is smaller. Levels of concentration of ownership is much higher. This shows the proportion of companies listed on stock markets that have single majority shareholders. In Austria, Belgium, Germany, a majority of companies that are listed on stock markets have a single shareholder owning more than 50% of shares. In the case of the UK and the US, that's less than 3%. And most of that large holding of companies is by families. So really what I'm saying is, if the Far East is looking to a model in the West as an indicator of how it should be reforming, it's certainly not the UK that it should be looking to. If anything, it should be looking to something that is much more analogous to what's been happening in the Far East, and that is continental Europe. And one of the features of these shareholdings in continental Europe, which, as I'll show in just a minute, is very different from the UK, is these are stable holdings. Okay, so this shows the proportion of family companies listed on stock markets in Germany where there was no change in control and there was some change. And you can see that in most cases there was no change in control over a period of 10 years. In France, there was even less change of control. In Italy, even less. Basically, once you're a family owner in Italy, you're a family owner forever. They just go on passing on family-owned firms through generations of families in Italy. In the case of the UK, basically, even if you are have family control, it's very unlikely you're going to persist as a family-owned firm. You'll get out of, the family will lose control of their companies very rapidly. So outside of the UK and the US, there's much more in the way of concentrated holdings and stable shareholdings. And that stability of shareholdings, although some people say, well, you know, it may not be so beneficial, it's a very important differential feature. And even comparing the UK with the US is not as simple as people think. People sometimes talk about the Anglo-American system. Well, what this slide's attempting to bring out is that actually, in many respects, the US is closer to continental Europe. This shows the proportion of companies that have got significant block holders, significant blocks of shares on the vertical axis. And along the horizontal axis, it shows the average size of those blocks. And you can see the UK down here with few blocks, and where there are blocks, they're very small in nature. The US, up there, is alongside most of continental Europe. And one of the reasons why that family and block holding persists in the US more than it does in the UK is it's a much more permissive system. It allows for companies to have protection against takeovers. It allows for companies to list on the stock market with dual-class shares. And that's been terribly important in some of the most famous companies that have been listed recently. Google came to the stock market with its owners, Larry Page, Sergey Brin, and Eric Schmidt, retaining a controlling shareholding in the company even once it was listed on the stock market. Reid Hoffman did that in the case of LinkedIn. And companies like Facebook, Mark Zuckerberg, retained control of Facebook after it was listed. The New York Times, the Washington Post, all of those have a dual-class structure. And the one that's perhaps the most recent example of that is the Chinese firm Alibaba, whose owner Jack Ma did not list on the Hong Kong Stock Exchange because basically as a former colony of Britain, the Hong Kong Stock Exchange has got the same rules as the London Stock Exchange. So he couldn't do what he wanted to do, and that was retain control within his partnership by listing on the Hong Kong Stock Exchange. And so he went to the New York Stock Exchange where he could. And even Manchester United listed on the New York Stock Exchange. You know, that's outrageous. Because the Glazier family could not retain control of Manchester United by listing on the London Stock Exchange. So we're basically through these very good systems of corporate governance, these rules, notwithstanding its comply or explain, we are discouraging stable, long-term family holdings from persisting. Okay, so really what I'm saying is that corporate governance is much more than about boards and stewardship codes and thinking about that. It's about how you structure companies in terms of their ownership, in terms of the way in which they interact with their employees, the purposes and the values of the company, how you structure all of that to achieve something that generates the right, real performance of companies, of economies, of industries in terms of entrepreneurship, innovation, investment, growth, corporate flourishing, all of those things, and also fairness. Fairness in terms of distribution, not just looking at efficient outcomes, but also those that are socially acceptable. And one of the points that I really want to emphasize is there is no right answer to this. To encourage those different types of activities, one needs very different types of arrangements. And I just want to illustrate this in relation to a survey that was done in 5 countries around the world, in the UK, the US, France, Germany, and Japan, of middle management of companies in those 5 countries. And that middle management was asked 2 questions. The first question was, do you think that your companies are run simply in the interest of their shareholders, or more broadly in the interests of their stakeholders, their employees, their suppliers, and their communities at large? And the response that came out was that in the UK and the US, the middle management thought that in 70% of the cases of the companies where they were asked, they thought that their companies were being run solely in the interests of their shareholders. As against in France and Germany, where 20% thought that was the case, and in the case of Japan, just 3%. And those differences really matter, because those same middle management were asked the question, if your company gets into financial difficulty, who do you think is going to bear the burden of that? Is it going to be your shareholders because the dividends are going to be cut, or your employees because they're going to be laid off? And in 90% of the UK and the US companies, the middle management thought that the response would be to lay off their employees, not cut their dividends, preserve their dividends, but rather lay off their employees. In 40% of the French and German companies, they thought that was the case, and in just 3% of the Japanese firms. And really what this is saying is that, in essence, there's an element of choice. It's in part a preference about societies. You know, what do societies really value in their corporate sectors? And it's in part a matter of what are companies doing? Because what is suited to a small, high-tech, startup company is very different from a large, innovative company. What is suited to an innovative company is very different from a traditional manufacturing firm, and what is suited to a manufacturing firm is very different from a service firm. So we shouldn't try and say that there is one system of corporate governance that is suited to all companies. Even leaving aside the social and distributional factors, which I say are very important focuses of this debate, even just from a pure efficiency point of view, we should not try to impose a single form of governance. Now, let me then take this quick trot around the world and go back to trying to answer this question about what China should be doing going forward. And I think it should be doing three things. It should be, first of all, being clear about what it perceives as being the purpose of its corporations. And I was arguing earlier on, it's rejecting the notion that the sole purpose of corporations is economic efficiency and the delivery of economic goals. It perceives that as being an important social function alongside that. And it then needs to align its ownership of its companies with that objective and its governance as well, by which when I'm talking about governance, I'm now referring to the way in which the companies are controlled, their boards. And I'm just going to give you a few examples of owners that I think are alternatives to the state going forward who can play that long-term role and preserve some of the social as well as the commercial objectives of corporations. One example being the Singaporean sovereign fund Temasek, which owns and manages the assets of the Singaporean government by making investment and divestment decisions based on commercial principles with the aim of delivering sustainable value over the long term. They look forward with a long-term perspective, and they foster an ownership culture which aligns employee and shareholder interests. So the notion and the objective of that fund is not simply to maximize returns on their investment. If they're looking at returns on their investment, it's first of all returns over the long term, not the short term, and secondly, they're interested in much more than just returns on their investment. Let me give you an example of an institution, a Western institution, a Dutch pension fund, PGGM, which has a responsible equity portfolio where they invest in a small number of companies, holding substantial positions in those companies for long periods of time, decades, where they look carefully to see whether or not those companies that they're taking concentrated positions in are really pursuing what are sometimes described as being ESG, environmental, sustainable governance policies. And they basically then provide assistance with ensuring that those companies achieve those environmental, social, and governance objectives by providing them with the finance when those companies run into financial difficulty. So it's a very different form of engaged investment from what hedge funds are doing, moving into companies, changing the management if the companies are underperforming, and then getting out quickly, having made a capital gain. That's not what they're there to do. They try to identify companies that have a strong environmental, social, and governance objective and then support them, not criticize and try and change them. And there is a very interesting innovation that's occurring in the US, which is termed the Public Benefit Corporation, where publicly listed companies state what their public purpose is, what is their social purpose or their public purpose alongside their commercial objectives, and where those companies state not only their purpose, but also are accountable to their investors for ensuring that they achieve those objectives. And if they fail to achieve those objectives, then the investors can sue the boards for failing to uphold those public purposes. So what I'm suggesting is that China is quite right to, first of all, resist the notion that the so-called model system of governance as observed in this country is appropriate for what it's trying to do. It is quite right to experiment with different types of models for SOEs, with mixed ownership, state and privately owned companies, different board structures, to encourage experiments as it's doing at the level of municipalities and provinces, encouraging them to use different types of structures, of governance structures, and to distinguish between different types of companies, between public service companies, companies that are the commanding heights, strategically important companies, companies that are might have a monopoly element, and those that are just regular commercial enterprises. In fact, it should go further than that. It should allow for a greater degree of diversity than just across those categories, recognizing the considerable difference of governance that should persist across different companies. And it can combine long-term ownership with a social purpose with private ownership. It can do that with continuing public ownership, but it does not require it. There are plenty of other long-term owners that could be taking those long-term stakes in companies, like pension funds, like sovereign funds, that have a natural interest in long-term, not short-term performance. And let me just very quickly end by making reference to another another Asian country, Japan, where there are equally significant debates going on about reform, where there the debates are about the fact that they have had a system of control which has been dominated by banks and companies having shareholdings in each other. And for a period of time, from the middle of the 1960s to the 1980s, it was associated with the Chinese equivalent, the Japanese miracle, the transformation of the Japanese economy and its growth, its remarkable growth up until the beginning of the 1990s, followed by the collapse as the banks collapsed at the beginning of the 1990s. And so it is now looking for a reform to its system, but the debate in Japan is very similar to that in China. It recognizes that there's a problem. It recognizes that these cross-shareholdings have had serious flaws associated with them, but they do not want to have UK-style, short-term, profit-focused governance arrangements. And what's been happening in Japan over the last few years, as this slide here shows, is gradually there's been increasing ownership by foreign institutional shareholders in Japan. It's beginning to encourage what one might term outside ownership, alongside the inside ownership, the cross-shareholdings between companies and banks that have prevailed in Japan up until recently. And in particular, in large companies, there's been a substantial inflow of foreign ownership. And really the question is, can this system of stable cross-shareholdings, together with more outside ownership, prevail going forward? Because what has been observed is that where there is this foreign ownership, the performance of companies tends to be better. They tend to perform better. So that's really what Japan is now trying to do. It's not so much the state withdrawing, it's more the cross-shareholdings, the stable shareholdings between banks and companies that are withdrawing and being replaced by outside ownership. That's the equivalent of the mixed ownership that the state in China is trying to bring about. And I'd suggest that just like in the case of China, it is perfectly possible for them to do it. They could try and do it through more regulation to protect outside shareholders, but I don't think that's the best way. I think it's much along the lines of what's needed in China. Companies should specify the purpose of the corporation clearly and make it the responsibility of boards to uphold the interests of the outside shareholders the foreign institutional shareholders, as well as the cross-shareholdings. And that will allow it, as in the case of China, to have a long-term focus with some of the benefits of having outside shareholders and the investments that they bring. So to sum up, what I think are the lessons from looking around the world for both China and Japan, and I could say similar things about other Asian countries such as Korea, which is also going through a period of reflection and transformation, is that corporate governance is much more than about boards. It's about the real performance of the economies of those nations. And it requires an appropriate balancing between the interests of different parties, the degree of commitment that's provided to different parties, and the control that they can exercise. And it requires that there is an appropriate form of regulation that doesn't, as in the case of the UK, prevent dominant shareholders from persisting or emerging. And China and Japan both can have essentially the best of both worlds through a hybrid system of stable insider ownership with outsider shareholders, provided that there is sufficient emphasis on the interests of the outsiders as well as the state in the case of China and the inside shareholders in the case of Japan. And what I'm really saying is not only are there lessons for China and Japan and Asia in general, there are lessons for Western economies, equally important lessons for Western economies, where they should be learning from the success of the Asian economies. Because that is exactly what we're trying to do in this part of the world, to restructure with a more long-term focus, as has been the core characteristic of Asian economies, where there is more of an emphasis on the interests of other stakeholders and of society more generally, and that we should really promote much more diversity and choice amongst companies in terms of being able to choose the types of ownership structures that are best suited to their activities, with, in many cases, having these long-term stable shareholdings and a clearly defined purpose that goes beyond that of just the shareholders. Now, I can't conclude a debate for an Asian Scottish institute without saying something about Scotland. And so that's what my final bit is going to be about, because I do believe that there are important lessons to be learnt within countries. And I can fortunately still say this is within countries. Differences between England and Scotland, as well as across countries. Because I think there is a lot to be said for promoting diversity. We have had, in the past, systems in this country in which there was immense diversity, in which we had stock exchanges all over the country, not just in Edinburgh and in London, but in Sheffield, Manchester, Birmingham. They all had their own stock exchanges. And what we really need to do is to promote not only diversity in terms of the financial system, but also diversity in terms of corporate form. I think that one of the things that ought to be seriously on the agenda for Scotland going forward, as devolution intensifies, is that it should have the power to set its own corporate laws. It should potentially be able to introduce things like the public benefit corporation, which I've been talking about as sweeping across the United States, that it should have its own stock exchange, stock exchanges in Glasgow and Edinburgh, as well as the stock exchanges in the UK. It should be able to establish what is just beginning to emerge of social stock exchanges that raise capital not only for commercial purposes, but for companies that are social enterprises and larger companies that have a clearly defined social and public purpose to them. There should be an expectation that institutional investors, in particular those that are situated in Scotland, such as Standard Life, should have a focus on doing exactly what PGGM has done, taking substantial shareholdings in particular Scottish companies, where it is responsible for the governance of those companies going forward. And likewise, private equity firms should have a focus, a local focus, and we should encourage much more in terms of local banks. The Royal Bank of Scotland shouldn't just notionally have a headquarters in Edinburgh. It should have a real focus in terms of being a Scottish bank with control residing within Scottish branches along the ways in which it used to reside in local banks across Britain and Scotland. What we want to do then is really to create financial systems and corporate systems which are much more local, much more social, and much more vocal than they have been to date within countries as well as across countries. Thank you very much.